Good day, fellow investors. As promised, we continue with analyzing stocks that Warren Buffett recently bought, and one of those stocks that we're going to analyze today is Chevron, the oil company. I'm also going to give an overview of the oil fundamentals, oil stock price overview, because oil stocks are totally dependent on oil prices, and I'm also going to spice it up by comparing Chevron and Lukoil, the Russian, let's say, counterpart. You can check my video on Verizon and the Buffett Pharma stocks. The link will be in the description below. Just before we start, please, if you like this stock analysis, if you want to see more of those stock analyses, click that like button. We have had more than 30,000 views on the Verizon and Pharma videos. I thank you for that. And click like button, share, and I'll do more and more of this interesting stock analysis. So let's start with Chevron. Of course, the stock did really well, 10-bagger over the last 40 years with good dividends. Was always considered a good dividend stock. Then we had the ups and downs with the oil prices crash, and now the COVID crash, up, down, and now we have recently the rotation to value. As people are going away from growth stocks, they are rotating into value stocks and oil stocks as low price to book values, and good dividend yields, high cash flows are considered value stocks. Now, what we have to see is how much value is there with Chevron at this stock price, and keep in mind that 215 billion market capitalization, because we're going to talk in market capitalization in billions for comparisons. Over the last 5 years, similar performance. Lukoil was a growth stock, then oil prices, of course, high. Then we had the first crash, then the COVID crash, up, down, and not rebounded as much as Chevron, but also rebounded as value. The market cap, keep the number in mind, is 60 billion. So that is a little bit less than a third of Chevron. When it comes to oil prices, so those are always volatile due to oversupply during the market crash and COVID situation, lockdowns. Even it went in Texas to negative prices, but also below 20. However, it soon rebounded, then stood around 40, and now we have again an explosion. And as Russia and the Saudis decided not to increase production, yes, it even boomed from 60 to the current 65. At 65, a lot of money is made in oil, but to see the long-term trend, we need to analyze the fundamentals in order to understand the risk and reward of investing now in companies like Chevron. So if we look at estimations for global oil consumption, now we have a disruptory trend from electric vehicles, from renewables, from everything, and also improved technological efficiency. This is, let's say, the Western forecast, BP, World Bank, Morgan Stanley, and they have a projection. If nothing changes, business as usual, oil demand would grow 20% from the current 100 to 120 million barrels per day. On improved efficiency with business as usual, that should be a little bit lower. If electric vehicles reach 78% of car sales by 2040, only then oil demand should peak somewhere in 2030 and then decline to the current levels in 2040. So this is, let's say, the Western projection. But let's go to a different view. Let's go to Russia. As I said, we'll compare Chevron with Lukoil, and they see peak demand already in 2025 in case of a transformation scenario, and they see in 2040 on the transformation disruption scenario demand of 70 million barrels per day. That's a 30% decline. Compare it to the Western projection that sees no decline even if EVs really reach huge market share. So who are you going to believe? Time will tell. Equilibrium also peaking in 2030, evolution and not considering global temperature increases and EVs, we peak in 2035 with oil. So I'm more inclined of looking at this way, not just because of transformation, but also because of technological developments. However, perhaps the reason why Warren Buffett bought Chevron, or some of his gang, Todd or Ted, is this. If we look at the cars that have been sold in the United States over the last years, people are not buying cars anymore, they are buying tanks. So light trucks as share of US vehicle sales in 2020 is going up to, what is this, 76%, while cars are down to 24%. So we are not driving small cars anymore, we are driving these huge tanks, which, okay, technological improvements make them consume less, but it's also a challenge for EV batteries with small cars. So very interesting. I'm looking at this and I'm thinking, okay, more iron, more aluminum, more steel, which leads to other investments. But if you look at sales, really explosion with big companies. Further, another bullish thesis for oil is that investments have been low, declining since 2014 when oil prices declined. Investment decisions have been declining in number, and we are really at historical lows of investing in new oil projects. This is of course because the expected declining demand, but if we look at production on existing projects, if they don't invest more, then there will always be undersupply of oil, and then prices could spike even more. However, if we stick to 100 million barrels per day, then cost prices to cover the supply in 2030 are still around $40 per barrel. $50 then should be the, let's say, profitable long-term average, and that's what I'm going to use in my calculations, because we can hold that with ups and downs, volatile, even if we lose 10-20% of oil demand over time. And if we look at the prices, this is a 2017 before the electric boom projection, we see that yes, for 10% increase in demand, prices should be 60-70, but for our normal demand we are around 50-60, recession we go down, so it will be very volatile. Prices, oil prices, this is the Urals oil price, around 70-63 in 2018-2019, average was 40, still was 40 in 2020, when Lukoil in this case made money also in 2020. What happened on the shorter term with oil? Of course, growth in production, growth in demand, then crash. They have cut production, but not enough. That's why you have seen the negative prices in Q1 2020 and Q2, but since then rebound, and demand is expected to be higher than the recovery in production, and that's why also you see a lot of these oil stock bets. However, how does oil work? If we look at the Baker Hughes rig count, so higher prices lead to more oil drilling, lower prices, less rigs used, higher prices, more rigs, oversupply, and now we have been very low in rig usage, but as the prices are going up, also rig usage is already going higher and higher, and if there are higher prices, then rig usage will also go higher and increase supply and consequently put pressure on prices. So these are the oil fundamentals. I'm sure it will be volatile. Long term, there are headwinds, which is something always to consider when it comes to investing, and very important headwinds. And now we have to see how those headwinds reflect on our companies. Chevron recently had an investor day, so we'll go through the key presentation points there. And this is Wall Street. They have production of 3 million barrels of oil equivalent per day, and they have to show growth. Wall Street, you always need to show growth, growth, growth. So from 3 to 3.7, this is approximately 1-2% growth per year. But what if the market declines? Then this growth will lead to oversupply. And we have seen Lukoil in this case, they have cut production, agreeing with OPEC to cut production and push oil prices higher. And you can see that they have cut their production by 10%, and they can reinstate this production if necessary. Over the long term, also projected growth of 1%, not even that much. They are focused on improving profitability. Another comparison, so Lukoil is producing 2.3 million of barrels per day, Chevron 3. So Lukoil is producing 77% of what Chevron is producing. That has to be put into the market cap comparison, 214 billion versus just 60 billion. So from a production perspective, Lukoil is way cheaper. From a debt perspective, Chevron really increased its debt to pay the dividend in 2020. It's a dividend stock. They need to do anything they can to pay dividends. That is 42 billion. Lukoil total debt is 660 billion rubles. Divide by 73 and you are somewhere around 8 billion. So 42 billion increasing debt, 8 billion in debt. So also from that perspective, Lukoil is way more value than Chevron. If we look at financial results, the free cash flows around 8 billion in oil prices at 60 for Lukoil, lower, what is this, 3.5 billion free cash flow in 2020, and that free cash flow leads to dividend payments. In case that oil prices rebounded as they have, I expect 6, 7, 8 billion in dividends from Lukoil, which compared to the market cap gives a 10%, 8 to 12% yield. Chevron has also such projections. In case oil is at 40 over the next 5 years, they expect to pay 50 billion, a little bit less in dividends, so that's 10 billion per year. Also take some debt to do that. If oil is at 60, they expect to pay the same stable growing dividend and use the excess cash or for acquisitions or for higher dividends. But still, with the excess cash, maximum I get to 70 billion for dividends. Divided by 5, what are we at? Around 13 billion per year. So to make a valuation, Lukoil makes 8 billion for dividends at 60, 2 billion for dividends at 40. We'll take an average of that. Chevron makes 13 billion and that is expected in 2025, so a little bit less, but okay, let's take that. Hopefully zero at 40 billion, but they say they will make around, what was that, 10 billion. But this year I checked, they made zero. So let's take those averages, let's take 50 an average and make a valuation. So I have updated my public analyzed stocks table so you can compare that. If you want my premium list of stocks, you can always check my stock market research platform, or for just starters, you can download this and see how it works. So Chevron, you click here, you go to the analysis, and I have put 8 billion in yearly dividends on average from Chevron, 3% growth rate for the dividend. Then, depending on oil situation, 0 after 2025, 10% discount rate, which is my required return, and the terminal multiple of 25% dividend yield required as a minimum, and I get to a value of 126 billion. 126 billion compared to the market cap, Chevron, from a value perspective, with those inputs, is overvalued by 100%. Of course, if things are much better, there is more growth, and I expect a 4% dividend yield, then we are getting closer to there, but given the headwinds in oil, I would not be so exuberant. If there are real headwinds and people start expecting a higher dividend yield, 10-11%, because of the negative long-term outlook, then Chevron's valuation is 56 billion. Of course, you can input here your inputs. Maybe I'm too conservative on the dividend, maybe it will be higher. You can check and play around. Let's go back to the table and check Lukoil. So from that perspective, 5 billion in dividends, growth of 3%, same there, 20 terminal multiple, then the intrinsic value is 78 billion. If I compare it to the market cap, then Lukoil is offering on average 11-12% return if oil prices stay 50, 60, which is possible until the next recession, until the next oil issue. If we are more exuberant with a 4% dividend yield, then we are at 107. On my platform, I have put here a terminal multiple of 10 for Russian stocks, but I put a terminal multiple also for Chevron because sometimes you need a higher dividend and it's good for comparison, especially for headwinds. But you can download this and play around. So, depending on where you look for value, there is different categorizations of value. Chevron stock from the current perspective is risky because people rotate into value without thinking about what value is, without thinking whether that value will be there in 5 to 10 years. This is just automatic. Okay, low price to book, low PE, high dividend, let's rotate into that. I don't like that. I don't consider that value. If I must, I look at value then in Russia, and that's something a little bit more interesting, but you always have to keep in mind the volatility of oil prices and then see how that fits your investment strategy. I'm following Lukoil, I'll keep following it and then see how it fits one of my portfolios. But that's something to be discussed in the future, perhaps when oil prices decline again to 40 or lower. Thank you for watching, please click that like button and I'll see you in the next video. We have gold coming up, just an update, some stocks, so please subscribe.